In the rubble of the 2008 housing crash, buried beneath the foreclosures and the financial distress are some of the most valuable lessons for today's real estate investors. How can a crisis that wiped out fortunes actually pave the way for successful investing? Join us as we embark on a journey through the wreckage, unearthing wisdom that could safeguard your investments and set you up for unprecedented success. From the importance of market understanding to the power of discipline, we tackle 6 timeless lessons learned from the housing market crash of 2008. Ready for the countdown? Takeaway number 6. Clearly define and communicate goals with partners. Partnerships can be a great way to leverage resources and share risks in real estate investing. However, misunderstandings can lead to business conflicts or even legal issues. To prevent this, ensure all partners understand their roles, responsibilities, and overall investment strategy. Regular, transparent communication is crucial to maintaining a healthy and profitable partnership. Regrettably, I once made the mistake of entering into a partnership without conducting thorough due diligence. This decision was based on the recommendation of a trusted associate who suggested I meet with one of his friends. This friend was said to possess experience in a niche market that could potentially be leveraged for substantial real estate investment returns. Misinterpreting my associate's advice, I assumed his recommendation to meet this individual implied that I should enter in a business agreement with him. It was an oversight on my part, and I bear full responsibility for it. Upon collaborating, I found that the individual was indeed a person of good character. However, he did not possess the specific knowledge critical for us to invest in this highly specialized market niche successfully. Had I done a thorough analysis and fact-checking, I would have avoided entering this partnership. I am committed to learning from this experience. In the future, if I consider a partnership in any investment venture, it will be initiated only after a detailed and explicit discussion. Every party involved will need to clearly understand and acknowledge the unique skills and knowledge they bring to the table. This way, we can ensure that all partners align well with the specific requirements of our investment strategy. If you are a longtime subscriber, then you know I often discuss topics of interest to home sellers, home buyers, and real estate investors because they're my customer base in Tallahassee. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts, and ignore the hype that is so prevalent online, then subscribe now and I'll keep you in the know. Takeaway number 5. Have a reserve fund. The 2008 financial crisis was a wake-up call for many investors who suffered significant losses. It underscored the importance of maintaining a reserve fund as part of a solid investment strategy. A reserve fund acts as a financial safety net capable of covering unforeseen costs. These might include property maintenance, unexpected vacancies, or financial shortfalls during market downturns. Having this fund in place provides the flexibility needed to weather challenging periods without compromising the stability of the investment. Interestingly, this insight is intrinsically linked to the earlier point regarding understanding roles and responsibilities in real estate partnerships. A common misperception can occur when all partners assume that someone else in the group will be the financial buffer during such tough times. Such misunderstandings can lead to a startling reality check when the partnership faces a negative cash flow situation. Moving forward, I am committed to avoiding this pitfall. Before entering in any future partnerships, I will ensure a thorough understanding of each partner's financial capacity and willingness to contribute to and sustain a reserve fund. This step is critical to the real estate investment's effective management and financial health. Takeaway number 4, quality over quantity. In the pursuit of expanding real estate portfolios, a common misstep among investors is an overemphasis on quantity, often to the detriment of quality. The ownership of numerous underperforming properties can become a financial liability rather than an asset. A more prudent approach is to acquire a smaller number of high-quality properties. These properties typically generate a steady, positive cash flow, attract dependable tenants, require less maintenance, and grow their value over time. In retrospect, my early investment strategy lacked a comprehensive set of criteria for property selection. I focused on rental yields, overlooking critical factors such as location and tenant demographics. For example, I acquired several properties near universities, attracted by the high rent relative to the property costs, thereby maximizing leverage through lower investments per property. However, I soon learned that student housing tends to have a high tenant turnover, and these properties generally appreciate less than mid-market homes with longer-term tenants. I have since refined my investment strategy to focus on purchasing homes in desirable areas where families live and where I anticipate sustained demand over the next 30 years. I liken my current residential real estate investment strategy to a baseball game. My aim is not to hit home runs, but to consistently hit singles. Pete Rose, who earned his place in the National Baseball Hall of Fame, was not a home run champion. Instead, his consistent ability to get on base made him one of the most respected players in the sport. Similarly, I strive for consistent, stable returns over flashy, high-risk ventures as a real estate investor. Takeaway number 3, stay disciplined. Market trends often generate considerable excitement, tempting investors to follow the crowd. However, remaining disciplined is crucial, basing investment decisions on robust research and careful analysis. Long-term success in real estate investment depends on this disciplined approach rather than emotional reactions driven by fear or greed. Adherence to established property criteria and purchase price limits can serve as a protective shield against market volatility. In 2005, when home prices surged, virtually everyone profited from investing in rental properties. I have always maintained a guiding principle for rapidly assessing potential investments. This involved evaluating a property's rent potential and acquiring it for myself or clients for less than 100 times its monthly rent. For example, if a property could be rented for $1,000 monthly, I would set my maximum acquisition price at $100,000. During the 2005 real estate boom, an investor client approached me with a desire to expand his portfolio. However, at the time, properties were selling for over 125 times the rent, and there was an increasing inventory of homes for sale. In line with my disciplined investment strategy, I advised him against buying, citing the expanding supply of homes as a likely precursor to a drop in home prices. He wisely took my advice and, several years later, found himself well positioned to purchase properties for less than 80 times the rent. This example illustrates the value of disciplined investment strategies and their ability to safeguard investors against unfavorable market shifts. There are times to buy real estate, and there are times to sit on cash. It is the supply and demand dynamic that will determine which is best. Takeaway number 2, invest for the long run. Real estate investing is a marathon, not a sprint. Short-term market fluctuations can be stressful, but history shows that real estate values tend to rise over the long run. As we saw in 2008, patience and perseverance can pay off in the face of a downturn. Resist the urge to panic sell and focus on your property's long-term potential instead. I explained to clients that the leading way to passively invest in real estate is to focus on leveraged appreciation rather than property flipping or other non-passive real estate strategies. Leveraged appreciation is a significant advantage of owning rental properties, particularly for small investors. In simple terms, leveraging in real estate means using borrowed capital to finance the purchase of a property. This approach's benefit lies in allowing an investor to acquire a property with a fraction of the total cost while still gaining the full benefit of its appreciation. Let's consider an example. Suppose an investor purchases a rental property worth $200,000 and only uses $40,000 of their own money for the down payment, borrowing the remaining $160,000. If the property appreciates in value by 5% in a year, that's an increase of $10,000. However, since the investor only used $40,000 of their own money, their return on investment is not 5%, but 25%. The $10,000 gain on the $40,000 investment. This is leveraged appreciation. This strategy essentially allows investors to grow their equity much faster than they could if they purchased the property outright. Moreover, the rental income from tenants can help cover mortgage payments and other costs, further enhancing returns. Of course, leverage is a double-edged sword, and it's important for investors to understand that just as it can amplify gains, it can also magnify losses if property values decline. Therefore, like any other investment strategy, it's crucial to do thorough research and exercise caution when using leverage in real estate investments. And takeaway number 1, understand the market. The 2008 crisis highlighted the cyclical nature of the real estate market. underscoring the importance of informed investing. Understanding key market indicators such as the house price-to-income ratio, the rate of housing price increases, and supply and demand dynamics are vital. Monitoring these indicators can help predict early signs of a market bubble, enabling necessary adjustments to your investment strategy to safeguard your interests. If you follow my YouTube channel or real estate blog, you will know my approach to analyzing and tracking the market behavior is more comprehensive than most. However, I wasn't always this vigilant. I began my journey in real estate investing in the early 1990s with a keen interest in understanding the intricacies of the housing market. I meticulously gathered and analyzed home sales data using financial analysis applications, leading to a robust understanding of the critical questions to address regularly. By the turn of the decade, I owned over 50 properties, each a prudent investment, propelling me to financial stability. Then came the market surge of 2003. My experience enabled me to continue acquiring properties without the same diligence in tracking the housing market as before. In a way, I had convinced myself that I possessed a Midas touch, attributing my success more to good fortune than to the dedicated market analysis I had been conducting. So when the supply of homes began to increase, I paid little heed. I was unprepared for the market crash that followed. My approach today is entirely different. My commitment to tracking the market is unparalleled, and I am well versed with the precursors that could lead to another housing bubble. Over the past decade, I've accurately forecast housing market trends, recognizing that the diligence of analysis, not any perceived golden touch, will safeguard my investments from future housing crises. The 2008 housing bubble was a harsh lesson for investors and provided invaluable insights for navigating future market downturns. By learning from the past and implementing strategies such as maintaining a reserve fund, prioritizing quality over quantity, staying disciplined, investing for the long term, and understanding market conditions, you can protect your investments and even thrive in the face of market volatility. As the saying goes, those who cannot remember the past are condemned to repeat it. Let's take the lessons from the 2008 crisis and apply them to our current and future investments. It's crucial to remember that real estate investing is not just about buying properties. It's about diligent research, understanding the market, and making informed decisions. Whether you're a seasoned investor or just starting, I'm here to help. My experience, gleaned from years of investing and learning from triumphs and setbacks, has equipped me to guide you in your real estate investment journey. If you're interested in investing wisely in real estate and seek guidance based on facts, not hype, then I invite you to reach out. Contact me through the comments or link below, and let's start a dialogue. I look forward to helping you achieve your real estate investment goals, using our lessons from history to create a more prosperous future. Together, we can make the most of your investment journey. If you want to see a video featuring my 9 tips for buying a home in a highly competitive market, you can view it by clicking on the box in the top left corner of your screen. Just click on the box below it to see a popular video featuring my top 6 home selling tips. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.